checklist down. Let's do this.
Let's do it.
In 3, 2, 1. Welcome to G Money Real Talk on everything mortgages and real estate. Today I'm joined by my beautiful marketing assistant and wife, Sarah Abrams.
Thank you. Glad to be here.
Yeah. I know I don't know. Am I crossing the line? Beautiful. You work for me.
No, yeah. Say it all.
Okay. Yeah. Well, hey,
I'll take it all. Bring it in.
All right. Well, I'm going to be honest, and that's the honest truth. You're beautiful to me.
Oh, thank you.
Yes. Okay, everyone. Here's a big story today, and we're going to talk about condos. And some people think I don't like them, and that's not the case. There's just very, very intricate guidelines. There's a lot that goes into lending on condos. Most do not know how in-depth it gets. And today we're going to blow your mind. Okay. Now, I think it's always very important, and the transparency should be there for you that is considering purchasing a condo. What is the additional costs? What is the additional rates? What is the additional vetting that goes into this? Because it's your money, and ultimately all of this impacts you as well as your potential resale. Okay. So I've got Sarah here to checks and balances. If I get a little too techie or get going off on a tangent, she's here to correct me, but also kind of question and make sure that we're really addressing all of the topics that I want to. So starting out, I just really want to clarify property types. And this is probably a good starting point because I'm just going to run through them all of, mortgage lenders, what do we lend on? And then we're going to kind of hone in on the condos specifically. Okay. Mobile homes. Sarah, do we lend on those?
Negative.
Okay. And why is that?
Because you do not own the land that the unit is on. And so then it is considered personal property, not a stick-built home, correct?
Yes.
Am I close?
No, yeah. That's great. What that is personal property, and mobile homes are literally registered with DMV. It's like an RV on wheels.
Yeah.
It could be in California today, and it could be in Texas tomorrow. And so there's huge risk. And so what we lend on is real property. And that word real is when it transfers over from personal to this real property whereas it is the land as well as the improvements. And that is the home or the structure that's on top. But then furthermore, it's with the county that it is conveyed from personal to real property, that it is taxed as such. So my terminology is very specific that you can get a manufactured home, which is very similar. And what is different is typically those are pre-manufactured. But where we have the difference is, let's just say you acquire the land. So you own the land that it's on, and you permanently attach it to the foundation. And that is the key, is that it's permanently attached. But that's not just it. Again, you have to go to the county and file forms, and there's a specific form that then, instead of being personal property tax, it is now real property tax, and you pay property taxes on it as such. And so there is the difference. So we just went through mobile home to manufactured home, and then we transition into condo versus a townhouse. Mm-hmm. And many people, including realtors, do not know the specifics that differentiate them. The names are back and forth. I've even seen condos with their HOA has a townhouse name in it. And so it's very deceiving, and it takes a little bit of vetting where we can look it up and properly decipher. A condo, you technically only own the walls in. So think of a condo complex, and you have multiple buildings. Those buildings are owned by the HOA, as are the common areas, the structure, the pool. And if there's 100 units, You as a condo owner own 1/100th of the land. So you own a shared percentage of that. If there were a total loss, it is the master HOA, so the homeowners association, that is responsible for rebuilding that. Your personal insurance, your personal homeowners insurance policy, rather, they have HO3, HO6. So HO6 is a condo policy where it's kind of like a built-up renter's policy. So it covers all of your personal contents, TV, couch, but then it will rebuild the interior, like your kitchen, like your bathrooms. It'll do the build-outs for that.
So okay, so there's a total loss. The HOA, the master policy, they will come in and build the structure.
Yes.
And then it's up to the homeowner and their homeowner's insurance to build out the inside
Yes.
of the unit.
And that is with an HO6 policy. Now, some condos have a master policy, and this is, insurance is a whole nother world that we can go real deep in.
Let's not.
But some condos have it where they call it walls in with betterments and improvements. And that means the master policy sometimes has coverage that will build it all out. So in those cases, we don't require the personal policy, the personal homeowners policy, but we do encourage it, right? I mean, if you have any type of loss, it'd be tragic and we want you to be covered. But
Right.
Again, as long as the HOA has the betterments and improvement, they call it walls in coverage, they'll do the whole build out.
How frequently do you see that?
50-50.
Okay.
Yeah. But as insurance is, dwindling in coverage, we're seeing more and more. And here's my small, just little tangent on this is as insurance costs are drastically rising, we're seeing HOAs making cutbacks to their insurance policies. And this is also causing issues. We're going to kind of park that and come back to that because it could be non-lendable if it doesn't have proper insurance coverages. And I have seen that and lent on that lately, and we have to resort to alternative lending programs. So moving right along on property type. So we have a condo, and I define that where you own just the walls in. Condos can be stacked, so there could be unit number 1 on the ground floor, unit number 2 above you. It doesn't really matter. Shared. Now, a townhouse can look very similar. I'm visualizing pretty much the same complex whereas what's different is you do not stack the units. So it is one unit, and you own not only the entire unit, which could be 2 to 3 stories high, but you also own the land that's underneath it. The difference is you own a fraction of the shared areas, the building, the pool, the common, the clubhouse, that kind of stuff. So for our purposes, for lending, a townhouse is drastically easier because you own your own structure completely. And so what is required of the HOA is much less, right? If there's a full total loss, you have an HO3 insurance policy that will rebuild your structure, and it's really just on you. So what are you paying HOA dues for is more like the clubhouse and the pool.
The amenities.
And some utilities. Sometimes they cover water, trash, etc. So much easier to finance, much easier on vetting. And a townhouse for a lender, we call it a PUD, a planned unit development. There's no add to the rate. There's not much vetting. We have to get sometimes the insurance policy depending upon whether the units are attached or detached. So if you're literally connected to your neighbor, then we do have to get the master insurance policy to make sure the coverage is, because that does pose a little bit more risk, right? If your neighbor sets a kitchen fire and it catches your unit on fire, then obviously there could be some litigation there. So That is condo versus townhouse. Was I
Yeah.
clear enough in that? Okay.
Yeah, I feel so.
And then we get into a single family residence. We're familiar. That's, you have your own yard. You have a house. We call it stick built commonly, where it's, framed with wood or the sticks. And that's, permanent foundation. It's attached to land. You're buying it as a package, land and improvements, which again is the structure of the house. We can have a single family residence that's within a gated community. You and I own one of those up in Groveland, and that is also called a planned unit development. So we pay HOA dues. We have a stick-built house that's independent from our neighbors. Looks like a normal neighborhood. The difference is we have an HOA that has 24/7 guard shack, shared amenities, features like that. So
Right.
that is a PUD, just like the townhouse is a PUD.
Okay.
And then we get into multi-units, which is self-explanatory: 1 unit, 2 units, 3 units. For residential lenders, we go up to 4 units.
Okay.
Got it. Okay. So why are condos so difficult to lend? And I'm going to tell you many, many reasons, and we're going to get into this again in depth, is they need to be vetted. And a lot of this happens to be because of risk. And I always say that, risk is for lenders what we're trying to mitigate. The higher the risk, the higher the interest rate, the more issues that could occur. Now, historically, and also kind of in recent events, we've had some catastrophic incidences which have kind of come down the pipeline to cause more issues into modern lending. 2021 in Florida, the Surfside condos collapsed.
Yeah. Devastating.
98 people died out of that. Okay. So imagine you just buy your unit and you're on your happy little world of, this is my little unit. It's perfect for me. Love the beach living. It's right here on the coast. Why did it collapse? And it collapsed because of deferred maintenance. So after that tragic incident, it has been this lending chaos world of making sure that every condo that we lend on does not have deferred maintenance. Now, they really define what is deferred maintenance, right? So,
So like, who is they? Is this the federal government? Is this an oversight committee? Like, when these kinds of things occur, so when the tragedy happened, who came in to determine we need to either revise or to put into guidelines? Who is they?
Yeah. Okay. Let me sidetrack and take a step back on that, because I do have the loan program that we're going to offer makes a difference on how we review and analyze the potential lending opportunities. Okay. VA, for all the veterans that can take advantage of a VA loan, it's a wonderful loan up to 100% financing. The condo HOA has to be VA approved, meaning the HOA has to take the time and expense to work directly with the VA, submitting documents, submitting the review fees, going through the process to get their complex approved. So in a resale world, as somebody comes to us and they say, hey, we're interested in this property and they're VA eligible, we, as long as the consumer, anybody can look up, you can just Google VA condo eligibility and you can search by the HOA names or narrow it down even by zip code or city, which condos are approved.
Okay.
It has to be approved. If it's not approved, we cannot do a VA loan for that particular condo.
Okay.
Here's the pros and the cons. Often new construction, we have Limoneira out in Santa Paula. I'll give you an example. They're new construction. They're a new builder. They want to attract any and every opportunity that they can. Most HOAs and builders will go after their VA approval initially. Years down the road, at some point, we often find that many of the associations dwindle on their.
They like let the cert like lapse or something.
That's correct,
like that. Okay.
because of the cost and the expense and the time that it takes to renew those.
Okay.
So that's a downside. You know, obviously it's kind of a bummer, but unfortunately that's what it is, and that's what we see. Not to say that, you know, some don't. You can see there's a pretty good mix on the, and it varies by area, of course, and how strong the HOA is, et cetera. So that's VA. FHA has a very similar thing where it has to be FHA approved, and you can go online, you can search FHA approved condos, and you can again narrow down where it's approved. They have ebbed and flowed into an additional process called spot approval. And that is where, let's say the condo is not approved, we can take the initiative to get our one unit approved. The caveat for that is they do not want a density of more than 10% of the units to do this within the complex, because they feel if we're doing a spot approval and 25% of the condos have done the spot approval, well, this is showing that the need is there, that the HOA needs to take charge.
Yeah, they need to step up their game and get their cert back into place or whatever.
Correct. So it's a numbers game that we have to make sure that obviously if we're going for a spot approval, our excuse me.
Bless you.
Yeah, sorry, a little cough and sneeze attack here. Yeah, FHA's got me allergic there. All right, the spot approval.
Yeah.
So if the spot approval, we have to know the percentages, and if we get our unit approved, would that push it over 10%? That would then make it ineligible, that we could not do the spot approval. Historically, they had this, FHA had this, they went away with it for some years, and it's back. So right now we do have that. The downside is it costs money and time. The last spot approval I did took about 3 weeks, and it cost the borrowers about $1,000. We also have to get the sellers on board, because there's a risk that we could go 3 weeks and it does not get approved.
Yeah.
So there's some significant added cost to that, and time, and it's work. It's work. Yeah.
So coming into that, then, this is where the knowledge of the realtor, knowing, one, what kind of loan program their client is utilizing.
Yes.
And where they're looking comes into play. Because like if they're showing their clients condos that don't qualify, they can be setting themselves up for some big challenges.
Well, this is the realtor's knowledge to know what is and is not acceptable, and or cohesively working with the lender to vetting what they're showing to their clients. That is something when I issue pre-approval letters and my pre-approval package, I'm not just writing a pre-approval letter. I'm looking up for all of these possible potential caveats that we have to make sure and vet.
Yeah.
So that's FHA. Then we're going to get into conventional, and this is where it gets a little bit more complex, is just to refresh everybody. Conventional, the two largest banks are Fannie Mae and Freddie Mac, and they set the guidelines for all conventional loans, okay? So there is good standardization. All lenders play by the same rule book. Now with that, Fannie and Freddie are different. They're not the same entity. And so I would say 95% of the guidelines are the same, but you could find a few of the differences amongst them. And I could highlight some of these things. Now, this is where, again, what loan you're going to do, you kind of need to know which path, because as we're doing the vetting, they have different methods for this. I'd say the VA is the easiest, because right up front, you know whether or not you cannot do that. FHA probably is the most complex just because of the time and the cost. So then many go down the conventional realm, and that's great. Now, a lot of people go, hey, we're 10 days into this, and now we're having issues getting the condo approved. Why didn't we do this? Why didn't we know this at the time of the offer? And it's very simple. It's time to do the research and the vetting, but it's also cost. So there's many documents that are required for us to review, to vet that, which are not readily available. You have to order them through the property management company. So you have the HOA, and then you have a property management company. And then additionally, most property managements now like to use third party like HomeWise Docs or condosearch.com, where as lenders come along and we need these documents, we have to log in and pay for these documents. And these documents can be upwards of $500. So it's not something that if you're just, shopping around looking and making an offer that you're willing to invest $500 right off the get-go. But then let's just say you are willing to invest $500, it still has to be submitted for approval. Now, let me give you an idea of what needs to be submitted to get approval, okay? Now, this is I'm going to speak in regards to conventional loans. If you're putting down 10% or greater on a conventional loan, okay? So you're putting a significant down. You have more money vested in it. So it's a little bit of a lower risk. And so with that, we're able to offer what's called a limited review. If you're putting less than 10% down, you're putting 3%, 5%, 8%, whatever that number is, then it requires a full review. So I'm going to go through a limited review. We need a lender questionnaire. This is on a limited, probably 20 to 25 questions. I'll give you some examples of those questions. How much are the monthly dues? How many units are delinquent? Does any one owner own more than one unit? They're looking for a heavy concentration. Does one person or entity own 25% of the units? Well, they can sway the votes of the board, right? Mm-hmm. You have more power there. Are there any deed restrictions? So deed restrictions come in of if there's a potential foreclosure, does the HOA have any stopgaps? Do they have the first right of refusal? What happens in the case of a foreclosure? Like these are those questions. Now, on all of these reviews, they get into deferred maintenance.
Sure.
And so again,
that goes back to the 2021.
Correct.
That we started with.
So even a limited review, if there's any deferred maintenance. Now, let me clarify what is deferred maintenance. Deferred maintenance are maintenance and repairs that were not performed when they should have or were scheduled to be, and which are put off or delayed for a future period. That Florida collapse, the deferred maintenance was in the foundation. That was part of it. The rebar, the concrete, it had eroded. It was, you and I lived at the beach for 9 years. The salt air, it is very hard on items, and it just deteriorates it. And that's ultimately what the cause was.
Right.
Now, some examples of deferred maintenance: broken windows, visible mold growth in the home, windscreens are ripped, foundation is cracking, wood siding has visible rotting, unstable decks, stairs need repair, broken or loose railings, plumbing issues, roof repairs, electrical issues or repairs, HVAC issues, wooden posts. All of those are examples.
Okay.
So again, they're looking for the integrity of the property to make sure that it is lendable and in a good manner. That's just the structure. Now, we get a lot of that information from the questionnaire. So we reach out to the HOA to fill out this questionnaire in real time. We also need to vet the HOA master insurance policy. So this is what I've suggested, where HOAs are making these decisions to cut their coverages, which if it doesn't have sufficient coverage, it could impact the lendability of that. We need any flood certificate to see if it's within a flood zone, which would then require flood insurance. We need the preliminary title report. So we want to look at how this property is vested, also the title search on that. We also need the appraisal. The appraisal is not there just for value. It's a boots on the ground with the appraiser to list any possible defects, any health and or safety issues that they may see. And it provides photos, real-time photos that are up to date that we can see, are there any of this dry rot, windows broken, things like that. Okay. Now, as we get into the full review, now it gets even more intense because we're now looking at, we need the budget, we need the balance sheet, we need a reserve study, we need to review all the CC&Rs, which is the conditions, covenants, and restrictions of that HOA. And then we also get into litigation. Now, this is one that, let's just say a stair rail is broken and somebody gets injured and they sue the HOA, that litigation could halt all lending on that complex. Okay. Because that is a deferred maintenance item, and that is also something that's against the HOA. And one of the big questions also on all of these questionnaires is the condo complex in litigation? And just because your neighbor is suing the HOA could mean that you couldn't sell your condo.
Right.
You couldn't refinance your condo. You could be really at a stalemate because of this external factor.
So that was, okay, so I just made that note. So someone who owns a condo, how involved can they be or should they be with all of these items? So like even the financials and the insurance, you're saying that like they're cutting their coverages. How would an owner know that? Are there meetings? Are there minutes? Are there things that they should be paying attention to for either voting or speaking up against those things? Or
yeah, absolutely. You're part of a club, a condos club, that you have a homeowners association as an owner, you're part of that association. They elect a board, which has president, secretary, all the typical board positions, and they have meetings, and those should be public, whereas you can sit in and listen to them. And quite honestly, if you own a condo, you should be involved in it to understand that. Now, anything that I'm talking about, the rules, the regulations, Fannie Mae, Freddie Mac, all of these guidelines are online. All of them.
They're accessible to anyone at any time.
They might be overwhelming. They might be scary to read or hard to decipher, but they are available. And so it would behoove the HOA and an owner to also maybe consult with a lender, see if a lender would sit in on these. If there's any lenders that own a condo, they should absolutely be part of the board to make sure that the decisions being made are in the best interest of the HOA. We've had a few recent situations where a purchase was in place and they were unable to purchase it with another lender, and we got involved where they were consulting with us. And essentially what happened was the insurance was going up $200,000 for the HOA.
Wow.
Per year. And so the HOA decided to make the cutbacks, and by cutting back, they eliminated required coverages for the HOA. And what it did is it kicked up the deductible, whereas the deductible was too high and they didn't have solvent reserves. So if there were a total loss, the HOA didn't have sufficient funds in their account to account for that. Now, we were able to step in and close this loan, but what happens, and this is terminology that is very key in the condo world, is it warrantable or non-warrantable? Warrantable means it meets all guidelines of Fannie or Freddie, and we can lend on it. Warrantable means it meets FHA guidelines and it is approved and we can lend on it. Non-warrantable means it does not meet guidelines. And so there are some lenders out there willing to take on that risk depending upon what it was. So in this last situation, the deductible exceeded 10% and their threshold was 15%. And so we were able to go to a non-warrantable lender to close the transaction. So it's not a conventional loan. Mm-hmm. This is that, back in the day, we used to call it Alt-A lending. It doesn't meet the QM or qualified mortgage standards that the government encourages. There's still lenders willing and able to do that. But again, it comes at a high risk, which equals a high cost. So that interest rate that they were willing to accept to get into that condo was much higher.
Yeah.
And it's unfortunate. It's not that we want to put them into that product. Thankfully, that product is there, or else they would not have had another solution. But that is what we deem as what we call a non-warrantable condo. Other times, back to the litigation, if somebody's suing, and we know there's frivolous lawsuits for all kinds of stuff, your dog's barking or whatever, if it's something that's not structural integrity or something deemed, by the HOA as a serious that could jeopardize the integrity of the condo units, then that would be okay. So I don't want to say just any litigation. I gave the extreme example about the staircase breaking and causing damage.
Like the health and safety stuff.
Exactly.
Yeah.
So, excuse me, the documents really play into this, and I've listed those. It takes, several days, unfortunately, and this is the thing. Right now we're doing a review, and we're about 10 days into it to getting our response today, whereas we've had to go back and forth to the insurance company to get clarification. Does it have this coverage? Does it have that coverage? What's the max deductible, to really understand? So those are those things that, again, until we have all the documents at hand, we don't know whether or not we can lend on that. It does make it a little bit challenging, but I want people to understand that we do our best. We hustle on these documents. We hustle on the time period. We have to get the appraisal completed. We need the preliminary title report. We have to get the condo questionnaire completed accurately. So many times we have to go back and have them, hey, you missed a few questions. We need better clarification. So that's very important. What I want to read is just a quick reference for condo eligibility for conventional loans. I'd say most of the lending that we do is with conventional, and that way you can kind of get an idea of what they're looking at. First, starting out is the max rental concentration for a full review. And what does that mean is if you're an investor looking to purchase a condo, the maximum number of units that can be investment occupied is 50%. And so we need to know what that ratio is. And why the heck is that important is it is found historically that owner-occupied take better care, right? There's more pride of ownership in their homes. And so if the max if it were 100% rentals, then obviously it would have a deferred maintenance. There would be, just more things, character flaws in the construction itself, by less upkeep. And, as owners of rentals, it's tough to invest money, and there's good landlords and there's bad landlords. And so I'm not trying to point fingers. I'm just trying to point facts and statistics that if it's out of sight, it's also out of mind. And so, do you make the repairs as fast as you need to? Not always. And so there is a limit on the rental concentration. No single entity may own more than 2 units for projects with 5 to 20 units, and 20% of total units with 20 plus units. Freddie Mac is slightly more. They go up to 25%. But again, the concept here is that the builder, retains 20 units for themselves, and, they have a larger influence or sway in the board. And again, it also pushes into the rental concentration. At least 90% of the units are conveyed to the purchasers. And this is I think we deal with that more on new construction, is the board needs to be turned over to the homeowners. So not just some outside entity. They want the homeowners to have the say of how things are handled. Needs to be substantially complete, no additional phasing or annexation. Okay, then they get into the budget, and there needs to be 10% of the operating budget in reserves, which is a big deal. And again, as we're seeing the cost increases everywhere, we're seeing that HOAs have to dip into their reserves for different items to pay it real time, which could obviously impact their reserves. So we result to HOAs having reserve studies completed where they consult with third parties to vet how much reserves they need and to make sure that they're on track. Now, reserves are inevitable. A roof has a shelf life. And so every 30 years, every 20 years, whatever that earmark is, you need to make sure that you have sufficient funds in the reserves saved up by the time that life expectancy is there to have it replaced. In certain cases where you do not have enough reserves, then they would do what's called a special assessment. So right now I'm working on a condo. It's a smaller HOA. There's only 6 units, and the roof needed to be replaced. And the HOA did a special assessment where each homeowner within a year had to pay an extra $10,000.
What?
Yes. Can you imagine getting that letter? Hey, we need 4 installments of $2,500 over the next few months to get our roof done. Yeah, that puts a financial strain, and they're able to do that, and they have to do that, unfortunately. So that is a special assessment, whereas that is not ongoing HOA dues. That is just to collect for a special item in an extreme circumstance. We do see that, and we have to allocate for that. We have to qualify for that. So if that were in the middle of that process where they're still collecting those dues, we would take that into account for the qualification of that.
Okay, so this is going back to the differences between property types. You're talking about roofs.
Yes.
Okay, so a condo, the HOA would replace or repair a roof because it's not the walls in. Would the same happen for a townhouse?
Townhouse is yours.
So you literally, so it's not just the property, it's the whole unit. So if your portion or let's say it's a four townhomes that are combined and they share a roof.
Yeah.
The 4 homes would have to work it out amongst themselves, type of thing. Is that how that goes? Or is that getting into the weeds?
That's getting into the weeds,
okay.
Because that's also whereas you'd have to see if it's attached to your neighbors, then more than likely, then that would be a common area thing. And that's why we need the master policy to see what is covered for the roofs and the structures and things like that.
All right.
So these are those vetting questions.
Yeah.
Like you definitely have to get to the bottom of that. One of the other things that they look for is commercial use. How much is that? We're seeing this more and more. I mean, you drive down Main Street right across from Ventura High School. They have shops underneath these units. You know, the concentration for Freddie Mac is only 25% commercial use allowed, whereas Fannie Mae is 35%. So, you know, I see the enticement, but then also right here on the avenue, we have some condos that have some commercial units that have sat vacant for years.
Yeah.
So, you know, I get the appeal for a builder to kind of do the mixed use, but again, you have to be cautious and know these guidelines. Let's say you build 30%. Well, now the only lendable method would be through Fannie Mae. You're kind of pigeonholing yourself into specific guidelines. You need to be aware of what these guidelines are. Yeah, it gets a little cray-cray. So, yeah. Now, the other thing I want to talk about is, again, I get hounded for a very good reason that everybody wants to obtain the very best interest rate. And, you know, I constantly explain this. There is not one rate every day that's published. This is it. There's pricing, but we have to build out your rate. And that build out is building out your scenario. What is your credit score? What is the transaction type? What is the loan to value? What is the loan amount? What's your credit score? What's the property type? What's your occupancy type? Literally every one of these makes a difference in the pricing that's offered to you. Now, for condos, if you heard me earlier, there's additional fees. So what are the additional fees is at closing, you would need to additionally pay for the condo questionnaire, any of the condo transfer documents, so to transition from a seller to the buyer, the HOA charges that. There's a processing fee. There's an actual cost to do it. A lot of times we see that paid for by the seller. Now, everything in real estate is negotiable. So just because I see that doesn't mean that's how your contract is written.
Sure.
So you need to make sure that who pays what. There is transactional fees to switch, from the seller to the buyer. You will pay for your questionnaire. That is a buyer specific item because that pertains to your loan. Without a loan, you wouldn't require that. So the sellers commonly do not pay that. That fee ranges from, I'm going to say on the low side, $250 to the high side, probably $500. And that needs to be paid up front at the time that the report is requested. I mean, you've seen it. You've dropped off checks for me to the property management companies that, hey, we needed to get this check that same day over there. Time is of the essence to get that completed. So that would be required from the buyers. Additionally, the HOA master insurance policy, to obtain a copy of that and also to obtain what we call an evidence of insurance. It lists your unit address, your name, us as a loss payee, so our mortgagee clause on there, so we have a vested interest in that policy. There's a cost typically to do that. There's some big common insurance agents that specialize in this. So we see it frequently, and they charge anywhere from, I'd say, low side of $75 up to about $200 just to get an insurance policy in your name. Okay. So minimum, I'd say you're probably $500, but expect $700, maybe up to $1,000. And then if you have to pay the processing fees for the HOAs, then you could be $1,500 in added closing costs. Now, we haven't even gotten to the HOA dues yet, whereas the month that we close, we're going to prorate the HOA dues plus collect an extra month. Some will make you collect 2 to 3 months up front. If it's new construction, and I'm getting more and more of this, new construction, they don't have all the reserves yet. So they have what they call capital contribution. So as a new construction to start out the HOA, you need to bring in And that number varies. I'm seeing 1,000, I'm seeing 4,000, I'm seeing 1,500. It's all over the board of how much they would require you to bring in.
Interesting.
Excuse me. Now we're going to throw a wrench. River Park. And the number of inquiries that I get for River Park right now, I have multiple loans going in the River Park in beautiful Oxnard, in the collection over there. River Park is a master plan community, meaning they have a master HOA. So whether you have a single family residence, you pay HOA dues. And that's about $50 roughly. Plus, if you're a condo in River Park, you now have your condo HOA dues. So it is not uncommon to have dual HOAs. Okay. Now think about that. The added cost, right?
Yeah.
The questionnaires, the master evidence of insurance, also making multiple payments. You're going to pay your mortgage company, plus you're going to pay HOA for your condo, plus you're going to pay the HOA for the master community. You have 3 different payments that you would make monthly for that example.
Right, right.
Yeah. Now, that's in fees. The other thing that I want to bring up is interest rate. And so again, you know, the enticement. What is the enticement is a lot of people see the initial price. Look, the average home in Ventura proper is $1 million now.
Right.
Okay. So if I can find a condo for $560 or $650, wow, I'm winning. However, you always have to look, what's the bottom line? If you have a $650,000 purchase price, but then you have $600 a month in HOA dues, how far off is that payment from a $875 house? Maybe you find something under the average, right? So there's homes available that I'm just saying as a critic and food for thought, look at not just the purchase price, but the all-in cost. The last thing that I really want to kind of get, and I was alluding to this, was on the interest rates that offered. Now, Sarah, right here, I have what they call loan level price adjustments. This is also available online. I encourage anybody that's interested in looking at interest rates and how they're determined, just Google LLPA matrix. And this is Fannie Mae that pops up. This is their chart of how the top section starts out. And let's pick a loan to value. Let's say you're going to put down 20%. Okay. Sarah, you following me on this chart?
I think so, yeah.
Shoot me a credit score.
Let's do 685.
Okay, 685 with 80% loan to value would have a 1.75% pricing adjustment just for the credit score. Now, let's say you and another borrower have a perfect 800 score.
Okay.
You still at 80% have a 3/8 pricing adjustment, 0.375.
So when you say pricing adjustment, that's adding on to...
That's not in the total rate. It's in the pricing, which determines the rate.
Okay.
Okay. Gets a little complex, but just understand the significance. 0.375 or 1.75, that's definitely going to impact your interest rate that's offered to you. Okay.
And this is specifically toward condos.
No, this is right now is just for credit score.
Okay. So for any, whether it's a townhome, single family residence, whatever, this is what it is.
Correct.
Okay.
Now we want to get to the condo level. Now at the 75 to 80% tier, a condo has how much of a pricing hit?
0.75.
So that means we have to add 0.75 just for it being property type condo, 0.75 on top of your credit score hit. The credit score hit was 1.75. So we have 2.5% of pricing adjustments. That means that your interest rate is going to be much higher than that 800 credit score. Now, let's look at this pricing hit for a condo. Really, the only time it goes down is if you put down 30%, it'll drop to 0.125 or 1/8. Mm-hmm. But anytime you're above 75%, it's going to have a 0.75 adjustment to the rate. So again, why is that there? Condos are a higher risk. And so with that, they have to price them accordingly. The risk of all the potentials, the what ifs that could happen with holding that note and securing that loan for the course of 30 years. It's very interesting to look at, and obviously looking at the chart, it'll make a lot more sense. But where I'm going, the ultimate moral of the story here, condos will have a higher rate. So when you're going with a loan officer, you need to be, these are those qualifying questions we should ask. This is part of our job, is to ask, what type of property are you interested in? What are you looking at? Oh, it's a townhouse. Are you sure it's a townhouse? Let's talk about condos for a minute. Have that powwow of what it means. If it is a condo, the interest rate will be higher, and you need to be aware of that. Now, I'm just going to kind of solve it up, kind of sum up here. How do we know if it is a condo for sure? And again, I kind of mentioned ahead of time, I've seen, the HOA is Sunset Townhomes, and it's actually a condo.
You've even seen listings on the MLS.
Oh,
that
all day long.
The listing agent has put up that it's a townhome.
Yes.
And it's truly a condo, or vice versa.
Yes. So
yeah.
What do I do? My initial thing, without doing the loan, without having the appraisal, without having all of that information, most counties, Ventura County does, you can go to Google Ventura County property characteristics, which is on their website, and it will tell you what the county has that property listed as. It'll be single family residence, or it'll tell you a condo. And so that's a good starting point. If it says condo, you definitely need to be on the lookout and assume that it is a condo. The second thing that I do is I pull internally a property profile. Now, this is not access to just everybody. You could go down to the county and pull records, but if you're looking at a specific property, I have access real time to pull up the history of that. And what do I do is I go to any previous financing that's been done, and I pull the deed of trust. So the deed of trust is the security instrument. When any lender lends on a home, we record a document called a deed of trust. If it's a PUD, there's a PUD writer. If it's a condo, there's a condo writer. So there's specific documents that get recorded that go along with the deed of trust that will clarify what it is. So again, if I can go to the history and see that another lender had all the resources at some time, the appraisal, the preliminary title report, the condo questionnaire, and they vetted it and it's a condo, there's a condo writer, well, I now know it's a condo. It's not going to change the property type that it is.
Interesting.
Yeah. Well, I've gotten in deep here. So we went over what a condo is. We went over what is needed to be vetted in the condo, why it's a higher risk. We've discussed the insurance. We've discussed loan programs, how to sniff out if it is a condo for sure. Am I missing anything?
I would just say from the outsider listening in that it's like you got to find someone who knows what they're talking about. Like when it goes into getting a mortgage product for a condo, like if I don't know. You got to know someone who's got the resources, who knows what they're talking about, because I could see that there could be issues down the line in the middle of escrow if a lender doesn't know how to navigate the world of condos.
Right.
And so finding someone who's experienced, who knows what they're talking about, who can get into the resources, because like you were saying before, like trying to vet things ahead of time, you have to do as much as you can ahead of time before you go into escrow.
Right.
But there's only so much you can find out until you get into escrow. And so then being able to have that lender who knows how to navigate all of that is pretty crucial.
Yeah. And a couple of things here, just tagging along that. Yes, being knowledgeable, and that's through experience, but also being detail-minded, that you understand, you have the knowledge of condos and the requirements for that. Number two, having a specific and detailed conversation with the clients up front, making them aware, this is the process for a condo, this is the additional process for a condo. this is the additional cost, and this is how it's going to impact your rate. You need to set clear expectations from day one, right up front, so that way, again, they understand, yes, hey, it could be a good deal overall, and this fits my price point, but I have to be aware of these ramifications. Additionally, it's always good to talk about, we don't want to be mid escrow and fall into the insurance isn't warrantable. So do we have plan B or C as a lender? What are those backup options and what do those look like? Hey, do we want to proceed at that point? Now, all of this pertains to the borrower and the purchase contract. So when somebody comes to me, and I know it's a competitive world, and so often they're like, hey, we want to reduce our contingency periods. And I say, if it's a condo, do not do that. So a contingency is an exit plan that during a certain specified time period, everything in your contract's negotiable. So whether it's 5 days, 17 days, 21 days, whatever that number may be, you have to do all of your research and vetting ahead of time. And if there's something that you don't like or can't lend on it, then you can execute your contingency and remove yourself from the contract without losing your earnest money deposit. If you waive that contingency, you're putting your money at risk, and that is never a situation that I would encourage anybody, specifically with a condo. So again, it kind of goes hand in hand with the property type. It's a lot more to vet. I'm not typically concerned with the borrowers qualifying on the condos. I'm more concerned with the property itself.
Yeah, so you need that time.
Yes.
You need all the time that you can get in order to get all of your documentation, research done for the ability for them to determine if the property is lendable, if there's any red flags, whatever it is. Yeah.
One last note here, and I have right now this situation going where I just lent on a property in River Park. Here I am 2 weeks later, closed escrow, and I've got another property in River Park, and it's the same HOA. Do we have to go through that process again? The short answer is no, as long as you're within a specified time period. Typically, our approvals for the HOA last for up to a year because things change. Insurance renewals change, things like that. So if it's within a short time period, then we can approve it without all the vetting. I'm sorry.
Bless you.
Yeah.
My goodness.
You're going to have to trim that. Okay. We got deep in the weeds with condos. Thank you so much for your time. And if I was able to keep your attention span that long on condos, you sure love condos. So without further ado, here's all the information that you need. Please call us, drop comments with any specifics you want to know. We're always here to support you. And without further ado, thank you. Like, share, subscribe. We're out. Peace.